Hey, good afternoon, everybody. Bobby Sharma here with Yonah. We're both going to be starting a new podcast called Higher Profits with Bobby and Yonah. Yonah is a really good friend of mine. We connected online and through mutual friends. Actually, I attended one of his presentations, a webinar, a while back, and since then we've just become really good friends. Thrilled to have Yonah and myself being the co-host of our new podcast called Higher Profits with Bobby and Yonah. Yonah, you want to add a few words?
First of all, this is incredible. I mean, obviously, podcasting is everyone that who knows me knows this is a new love of mine, and I've been a guest on over 50 podcasts, and so being a host is a whole new realm. And so we're going to be doing this new together, but it's going to be fun. So I'm pleased to be doing this, and I'm pleased to be doing it with you, Bobby. So
thank you, sir. Yeah, and so we've got the East Coast and the West Coast and Israel all represented here, and so I'm thrilled. I'm so glad we connected, and our goal is really to educate our audience. This is not meant to be. We're not selling any products. We're not selling any services. It's purely educational, and we will bring in some really amazing guests for our podcast. So. Yonah, if you want to introduce Bernard, that would be awesome.
It would be my pleasure to introduce my good friend Bernard Reisz, hailing from Brooklyn, New York, who is a retirement account specialist, a CPA by practice, and really specializes in that. Unfortunately, we're not going to be able to cover that topic today because it's such a huge topic, and we can really get into that in the future. We'd love to talk about a topic that is so necessary. Even before you invest in real estate, something that everyone needs to know, which is how do you even go about selecting an entity to buy that property, right? You want to buy a property, you just go and buy it. You have to create a corporation. What do you do? An LLC? Which state should it be in? Where, I live in this state, properties in a different state. It can be really confusing, and some people don't even know where to begin. So even though it's a huge topic, it's my pleasure to introduce Bernard. Maybe Bernard, you want to take a few seconds just to introduce your own self.
Absolutely. And but firstly, I've got to say thanks to Yonah and Bobby for inviting me on. This is truly an honor to be part of this kickoff event, the first episode of Higher Profits with Bobby and Yonah. Bobby, it's great to get acquainted with you. Yonah is somebody I've known for a while, admire, respect. We've crossed paths in so many places, and I love what Yonah does for investors, saving them on taxes. And it's a world that's very close to me. Yep. And on that note, a bit about myself. I am a CPA. In addition, I hold financial insurance, securities licenses, and several designations. Overall, my philosophy is twofold. One is you've got to recognize that anything financial, you're at the center. You can have advisors, you can have people that you talk to. It's your finances, it's your life, your responsibility, and you're going to bear the risk and rewards. And secondly, you've really got to take a multi-dimensional approach. So you got to think about so many different components and different tax, legal, and financial factors when you're getting set up. So you may think you can go to your accountant and that should be your sole resource, or an attorney and that be your sole resource, or a financial advisor and that be your sole resource. But in truth, every question is going to bring multiple disciplines to bear. And you've got to take all of those into account. And that comes back to you being at the center and being able to talk to those professionals and then bring all those different factors together and make the decision for yourself. And we'll see when we talk today about business entities, entities for real estate investing, we'll see how that is really the case. And Yonah, you said we wouldn't talk about retirement accounts today. We just can't avoid that topic because the choice of entity is very closely tied in to your retirement accounts, to your tax deductions that you can get. So we're going to try to take a holistic approach, and I'm ready to kick this off as soon as you guys are.
Let's do it.
Awesome. So actually, Bernard, real quick, one of the questions that I get very frequently is people that are based in, let's say, California, but they're doing deals in the Midwest, they're doing deals in California. Some of them are flipping, fix and flips. Some of them are buy and holds. Sometimes they're doing it alone. Sometimes they're doing it with a spouse. Sometimes they're doing it with a partner. What are some of the things that you would kind of caution them or highlight, kind of point them in the right direction as they go about searching for, where to establish their entities, given that their residency might be either, let's say for now, California?
Okay. Great topic. And one of the things that it's important to say when you talk about LLCs, one of the things that you most often encounter in various online forums and promoters is form your LLC here, form it there. You'll save money if you form it here. So let's break it down and see what exactly does an LLC do? What does it do from a legal perspective? What does it do from a tax perspective? So to back it all up, sometimes, and even in this conversation, we've heard, should I have an LLC or an S corporation? And in truth, LLC and S corporation are completely different concepts. LLC is a legal concept, and an S corporation is a tax concept. So if you go look in the tax code, you're not really going to find anything about limited liability companies. Limited liability companies are created under state law. It's a legal concept. Now, the tax code will determine how a particular entity should be taxed. So an LLC can be taxed as an S corporation. An LLC can be taxed as a C corporation. An LLC can be taxed as a partnership or as a disregarded entity. So the most fundamental, most elementary concept to realize is we've got legal concepts and tax concepts. And then we can kind of mix and match them. So an LLC, limited liability company. S corp is a tax concept. Corporation, though, again, is a legal concept. So LLCs and corporations are formed with individual states or domiciles. So you can form your LLC with California or Delaware or Nevada, Alaska, Wyoming, New York, or Washington, D.C. Alternatively, you could form a corporation with any of those states. Once you form that entity, you'll have some choices with how you want those to be treated for tax purposes. So those are called the check the box regulations, where the IRS lets you say, okay, you've got an LLC. Now you have multiple options how that LLC will be treated for tax purposes. Does that make any sense? So we've got to break up the legal side and the tax side.
Absolutely. So what's the first step? I mean, the first step is really from the legal side, correct? Because you're going to be treated for taxes once you have that entity and it's making any money and having to be taxed. So the first step, I guess, would be chronologically. Is that correct?
I think it's to a great extent, it's kind of circular. It's not really a linear process. All the parts are interdependent. But what you want to ask yourself in the first place is, why do I form an entity? Right? You don't need an entity. Certainly from a tax perspective, you do not need an entity. A business is a business. So you've got to ask yourself, why am I forming an entity? And I think it's really, really important to emphasize that, because there are so many people out there that think that they don't have a business until they have an entity. And occasionally they may have an entity that's doing nothing and they feel they have a business. And ultimately, action is more important. That's the key thing. It's really action. This entity thing is very important, but I also find it being something of a distraction. People that get into investing, they get a bit distracted going down different rabbit holes, and expend lots of resources getting an entity, and they should be focusing more on action. Where's my deal? Where am I going to invest? That really drives everything. That being said, why would you have an entity? So as you said, Yonah, certainly legal reasons is because an entity will give you legal protection. It gives you asset protection. It's written into state laws, that these business entities provide very powerful asset protection features. These will vary somewhat by state to, from domicile to domicile. But for the most part, you're looking at two types of liabilities and two types of protections. There we talk about inside liability and outside liability. Now, those terms may sound odd. Once we explain them, it'll be really, really understandable what we call inside liability and outside liability. Let's take a real estate investor who buys a property, buy and hold asset. Well, there may be some liability that happens within that property. Maybe a disgruntled tenant decides to sue. Maybe there was a guest at the property that had some sort of accident. Well, they're going to try to sue whoever they can. Well, they'll go after the landlord. So that's inside liability. That's liability that happened within the LLC, within the asset. Property. Right. And they're going to want to go not only after the property, they want to go after your personal assets. And the idea is the LLC will protect you from that inside liability. How about the other way? Outside liability. Suppose you, the owner of that LLC, have some sort of liability event, and somebody is suing the landlord personally. Can they
not having to do with the property? They're just coming to sue, a guy
exactly
crashed his car into or whatever.
Right.
That's exactly it, and that's what we call that outside liability. That's something that happened outside of the LLC. Well, can they go after your property that's within that LLC envelope? And the answer is an LLC does provide a measure of protection in this case, and in fact will provide most likely a greater measure of protection than a corporation, and not in all circumstances. So the idea is, while you don't personally own that property that's in the LLC, you do own the LLC, right? Just like if you had stocks or bonds in a brokerage account, they may want to go after that. Well, here you've got ownership interest in a limited liability company. So that is an asset of yours as well. Well, for that, there's something called charging order protections, which state law says that the ownership of an LLC cannot be foreclosed upon because, an LLC is a kind of like partnerships, and we don't want to have even though you may have some liability, there's no liability on behalf of all the other partners, and we don't want this third party, unrelated party that has some liability claim getting ownership or control or management interest somehow in this LLC. So he's limited to a charging order protection, which enables him to get distributions. So if the LLC says we're going to make a distribution to all the partners, okay, he can get his hand on that distribution, but he cannot foreclose on the LLC interest itself. And so that LLC interest and the actual property that's in the LLC has protection through charging orders. So inside liability, outside liability. How we doing, Bobby?
Very well. Very well. Thank you. I really enjoyed how you explained that in very simple terms. And I'm hoping that our listeners and our viewers are going to be able to absorb that and keep that in mind as they make their legal and financial decisions and investment decisions. Thank you. Very good, Bernard. Keep going.
Okay. Now, there are distinctions among states. Now, can I toss a question back to you?
Yes.
If you have a single member LLC, an LLC that's owned by one person, would he have charging order protection? If he has that outside liability?
Yeah. From what I understand, in California, that person does not have the charging order protection.
And you're absolutely right. And the logical reason for that is there are no partners. right? It's the concept, that underlies charging order protection is that there are lots of people here. But if it's just you, well, okay, you're liable. We'll take over your interest and move on. Now, there are a handful of states that explicitly provide charging order protections to single member LLCs. And that's one of the factors you want to take into account when forming a single member LLC. So most states will provide charging order protections to a partnership. But to a single member LLC, an LLC that only has a single owner, not two partners that are owners, you've got to cherry pick the states that provide that. Now, California is an interesting animal because when you have spouses that own an LLC in California, it may be community property. So California has a lot of nuance with everything related to single member LLCs with spouses because it's community property. And this also takes us a bit to the next segment of this, which is the tax side. So we know one reason you're going to think about when you form a business entity is the asset protection component.
Right.
And asset protection, I think in most cases, it really shouldn't be much of a thought. The relative cost of getting LLC started, if you're working with a provider that's reputable and reasonable, is absolutely nominal. Yes, you can find people out there that are promoting all sorts of convoluted things, and they're looking for, to charge people an arm and a leg to get these things set up. But if you're working with somebody reputable, interestingly enough, the cost will probably be very reasonable. So in my eyes, from an asset protection perspective, LLCs are a no-brainer. California, since we've got this California spin, California is the most expensive state in the union to have an LLC. Because California, the FTB in California wants $800 per year for any LLC that's doing business in California. Now, that includes an LLC that is registered with the state of California. And to a certain extent, if you're in California and you've got your Texas LLC, California may still want $800 per year from the Texas LLC. Even if the LLC is a Texas LLC with a property in Texas, the FTB, and for all the listeners that are not from California, that's the California Franchise Tax Board. Very ominous, they're kind of aggressive, and they may feel if you're a California resident and you've got some sort of LLC in a different state, that they're still entitled to that $800 per year. No other state has that. The closest runner-up is going to be Massachusetts with $500 per year. And then there's no third runner-up that's even close. Well, actually, Nevada. Nevada is something that I feel it's important to point out because I think it's too heavily promoted by people that are saying, get your Nevada LLC. And Nevada LLC is actually very expensive to maintain. So some of the most expensive states for LLCs are California, Massachusetts, and Nevada. Now the question is, let's talk about the tax side a bit. And before, I say, provide my perspective, if I were to ask you, what are the tax benefits of having an LLC? Any thoughts?
I can't think of any.
Okay. That's the best answer I've gotten so far. And you'd be amazed at how many promoters on the internet and even professionals, attorneys that are out there saying form your LLC in Texas and you'll get tax benefits. Texas has no income tax. You get no income tax benefits for your standard LLC. Your standard LLC, before you make any tax elections, will be treated either as a disregarded entity or a partnership. Yep. Let's talk about disregarded entity first because that's really simple. Essentially, the IRS says we look right through it. For tax purposes, this thing does not exist. You got your asset protection, that's wonderful, but it's just you, right? And it's just you wanted to go to your state, get some asset protection. For tax purposes, it's the exact same thing. Nothing has changed. It's not even a pass-through entity. it is called a disregarded entity. It's as if it's not there. So there are no tax benefits, income tax benefits, to having your LLC in Nevada, Texas, Delaware, Wyoming. The IRS is going to tax you no matter where your property is. And for the most part, if you're in a state that has an income tax, they're going to tax you on your assets and on your income, whatever the source is. So if you're a California resident investing in Texas, with a Texas LLC, California is going to collect income tax on your Texas income. Same ditto for your New York investor. New York investor investing in Florida or investing in Texas, investing in Nevada, or certainly if they're investing in California with a Nevada LLC, that's certainly not going to help them. But essentially, it's all the same because the state's going to tax you. If you're a resident, they're going to tax you on your income wherever you earn it. So no direct income tax benefits to having an LLC. And if anybody tells you form your LLC in Nevada or in Texas because you're going to save taxes that has no state income tax, look for another provider.
Yeah.
Is it fair to assume you've seen this kind of stuff promoted?
Yes,
sure, of course.
All the time.
Of course.
Okay. So let's talk for a moment about partnership LLCs. So a partnership LLC is just an LLC that has more than one owner. So the default tax treatment of an LLC with more than one owner is going to be a partnership. Now, a partnership is a pass-through entity. It's not a disregarded entity. So it's a little more convoluted than having a single member LLC. But essentially, all the income and deductions flow through to the partners. But the partnership actually files its own tax return. So a partnership will do an informational filing of Form 1065 with the IRS. And for the most part, it's just a way of letting the IRS know, okay, we had activities within this LLC, and this is how it gets allocated. This is what goes to partner A. This is what goes to partner B. Now, there's a lot of complexity to partnerships, potentially, but in your plain vanilla scenario, that's all it is. The partnership is passing through the items to the owners. And again, it's very much like having a single member LLC, except that the partnership does its own filing. That makes sense?
Makes sense.
Of course.
Makes sense.
Yeah. So you're essentially, for tax purposes, the multiple members of that LLC are just getting taxed individually based on their interest or ownership of that LLC.
Yeah, that's exactly it. There can be differences, but I know, Yonah, you're very active in the world of limited partners.
Right.
So there certainly can be differences in tax treatment for general partners and limited partners with regards to employment tax. On the income tax side, there will be no distinction. But on the employment tax side, we can have distinctions there. And I'm trying to figure out, there's so many different ways we can take this.
I know.
I think, the next step is, let's talk about employment tax for a moment.
Yes.
Because that will let us segue into S corporations.
Yes.
And then bring this full circle and talk about potential tax benefits with having an LLC, showing why it's not only a legal perspective, why there is a tax component to this as well. And when people think of taxes, what they're thinking about usually is income tax. People don't think enough about payroll taxes. Certainly, if somebody is strictly a W-2 employee, that's their background, they're going to think about income tax. Somehow, when you're an employee, the payroll tax, although it shows on that W-2, it shows on your pay stub, you never kind of feel that money. You don't feel that pain because it never hit your bank account. So it gets overlooked. But when we talk about taxes, there's income tax, which is assessed as a percentage of your income. And there are various income tax brackets which change from time to time. So we had one set of income tax brackets. It changes. Right now under TCJA, we're looking at a max 37%. But those are the tax brackets we're used to seeing. And that's assessed on all your income at graduated rates. So the first slice of your income is taxed at one rate. As you get to progressively higher levels of income, those higher buckets are taxed at higher income tax rates. So we've got what's called a progressive income tax system. You begin paying more when you begin earning more. But there's another component to the tax, which is your payroll tax. And that's related primarily to Social Security. Those are called FICA, FUTA, and SUTA. So these are, and there's FICA High. There are a bunch of different components, but once you bring it all together between the state and federal, you're looking at approximately 15% in payroll taxes. So that's a huge number. 15% to pay and stack that on top of your income tax, that's huge.
Right.
Now, when you're getting a W-2, that 15% gets divvied up. Half is paid by the employee and half of it is paid by the employer. Of course, we'd be foolish to think somehow the employer is paying that. It just means wages are automatically calibrated to account for that. Your employer knows that if they pay you $10,000, that they're going to have to give 8% of that. So when they make their calculations for what kind of salary offer they're going to give you, what the package is going to look like, of course, your employer is thinking about the total cost to them. So what happens is, for an employee, it gets shared. If you've got your own business and you're a disregarded entity, if you're a sole proprietor, then you pay the full 15.5% yourself. Any questions about this stuff?
No.
No, it's pretty clear.
Okay, awesome. So this will kind of explain why somebody would consider an S corporation. And I'm going to toss out ahead of time the caveat that I think S corporations are over promoted. So, but let's first talk about, so yeah, I'd say chronologically, there was a time where S corporations were not promoted enough. And then anybody with Google got the idea that S corporations are amazing. You're starting a business, get an S corporation, saving payroll taxes. So now I think we're in the, I'm a post S corporationist, if that exists.
It's very nice. Yep.
I think now they're, just like everything tax related, there's a lag and then the masses catch on and then everybody's promoting it, even when it shouldn't be. So I'm fairly certain that's the case with S corporations as well. But let's talk about why would you have an S corporation if you're starting your own business, and why shouldn't you have an S corporation in many instances. And let's talk about real estate investors in particular, because this is really important. And for the moment, I think let's talk about two distinct types of real estate investors. We've got your buy and hold investor, which you talked about, as well as your flipping real estate investor that you mentioned. Right. You've got people that you work with that are flippers.
Yes.
Now, your buy and hold people are subject to one tax regime, and your flippers are subject to a different tax regime, potentially. Now, when that flipper is going to be subject to the tax regime we're about to describe, they're going to have to work that out with their CPA, because there is a gray area here. But suppose somebody is a bona fide flipper. Real estate, they're always constantly buying and flipping, buying and flipping, buying and flipping, wholesaling, or actually buying and flipping it. That's not very distinct from buy and hold. When you got to buy and hold, you get rental income. Rental income is only subject to income tax. I know, Yonah, I know rental income investors don't pay income tax ever. I know that. But
it's subject to it, potentially.
That's right. If they don't know Yonah, then they may be paying income tax on their, what they're collecting from their buy and hold properties.
Yep.
So anybody out there, if you got rental properties and you've been paying income tax, get in touch with Yonah. So let's talk about the buy and hold for a moment, because that's distinct. Your rental income is subject to income tax, but rental income is not subject to payroll tax. So the tax code explicitly pulls your rental income out of that category of income that's subject to payroll tax. But a flipper is a trader business that would go on a Schedule C. Rental income, for those that do their own taxes or that actually look at their tax returns, rental income goes in a Schedule E. Flipping income will go on a Schedule C and be subject to payroll tax. So in addition to the income tax, you're going to be paying payroll tax. And if you're a Schedule C, which means if you're an LLC that's a disregarded entity, or a partnership that's a pass-through, or you're a sole proprietor that has no business entity, you're going to be paying income tax plus 15.5% towards payroll tax. Here's where the logic of an S corporation comes in. When you've got your own small business, you can run it like the big boys.
Right.
And you can say, hey, I am creating something that has a corporate identity. You can create a corporation with the state, or in most cases, you can create an LLC with the state and just vis-a-vis the IRS, treat it as a corporation. So you tell the IRS, hey, this LLC that I've got here, I'd like to treat this as an S corporation. Let's leave C corps out because they just don't apply to most people. There are cases where they apply, but we've got limited time. And let's try to keep this as focused at least as we can. So with a C corporation, when you have an owner-only C corp, you have to be an employee of the C corp. You do work for the C corp, you are an employee. And in that case, you have to pay yourself a salary. Mm-hmm. The IRS expects you to.
Right.
But here's the thing. An S corporation, let's talk about S corporation is earning $100,000 per year net. Let's use round numbers, simple numbers. Mm-hmm. If you take that $100,000 purely as a distribution, say, hey, this is all profit, mm-hmm. you don't pay any payroll tax. But the IRS says you've got to pay yourself.
You have to.
Suppose you take $100,000 as salary. Hey, the business made $100,000. You pay yourself $100,000 salary. Well, you're going to pay payroll tax on the full $100,000. But what you can do potentially is say, hey, we made $100,000. I'm not going to take all that as a profit distribution. I'm going to create a business expense called wages, like the IRS wants me to, but I'm not going to pay myself the full 100. I'm going to pay myself some portion of that. So say I'll pay myself $50,000 as a salary, and then $50,000 I'll take as a distribution. Well, you'll only pay the payroll tax on the $50,000 that you've got as a salary. The $50,000 that you take as an owner distribution will be subject to income tax only and not be subject to the payroll tax. So essentially, you'd be saving yourself 15.5% on $50,000. Not bad. Not bad at all.
Right. So that's only being done when you're creating this, creating this corporation.
Exactly. You'd be an S corporation for tax purposes.
Okay.
And Bobby, what do you say, Bobby?
Yeah. So, and I believe you're going to compare that to a C corporation. Like, what would the same scenario play out in a C corporation?
So we'll talk about C corps for a moment. Yeah. I'd rather contrast it with disregarded entities, okay. Because C corps, while they're more appealing since tax reform, they're still not ideal in most scenarios. So a C corp is subject to double taxation. So a C corp, again, you'll have that, you'll be a salary and all that. But when the company makes a distribution to you, the company is going to pay income tax, right? So in a C corp, take the same scenario, $100,000, $50,000 salary to the owner. Now the C corp has $50,000 in net earnings. The C corp is going to pay 21% income tax on that at the company level. The S corp pays no tax at the company level. It passes through its net income to the owner.
Right.
So the C corp will pay tax, and then when the C corp actually distributes that $50,000 to the owner will pay tax on it then. Again, at probably about 20, a rate somewhere between 0 and approximately 25%. But once you stack the two layers of tax, you generally end up coming out behind. So a C Corp is not ideal in most scenarios. It's much more appealing since tax reform. Prior to tax reform, C Corps could pay 35% tax. So then you were stacking 35% plus your personal income tax, and then you were looking at 55% to 60%. Right now it's 21% plus your personal, but you'll still generally come out behind using a C Corp. Within retirement plans, there are unique opportunities for C Corps, but again, that's off limits for today. So let's talk back to contrasting the S Corps with a partnership or single member LLC. And I think for simplicity's sake, let's leave the partnerships out. Let's do C Corp versus disregarded entity.
Right. So, because we're talking about people who are, maybe our listeners right now are thinking, hey, I'm about to buy a property, whether it be a single family or a commercial property, out of state, and I'm creating this entity, right? What should I be doing? And, we already discussed what the asset protection is going to be by creating the LLC, protecting yourself and your assets inside and outside. It is a great description, but now we're talking about, which one is going to be more, comparing them, which one is going to be more beneficial. Exactly.
And for tax purposes. So again, it's S Corp versus disregarded entity, single member LLC. So let's take our two investor profiles. We've got our buy and hold investor is one perspective, one investor profile. And then we've got our flipper. So for the flipper, he would be subject to payroll taxes. And so he would want to consider having an S Corp to mitigate that payroll tax liability. So if he's going to run $100,000 net income through his flipping business, he may want to have an S Corp. Now, again, S Corporation is a tax concept. But if you are a sole proprietor without an LLC or a corporation, you cannot be an S Corp. The IRS says if you have an LLC, you can choose to be an S Corp or a disregarded entity. They'll accept either one. But if you do not have an LLC, then you cannot choose to be an S Corp. So there is a tax reason for forming an LLC because you want to have the flexibility and the ability to make that S election with the IRS. And that's only available if you've got a legal entity. Right. So I think, Bobby, you really want to, when we talk about tax benefits of having an LLC, the one-word answer is really the one that you gave, no tax benefits. Right. But there's the potential, that indirect benefit, if you make the S election, and that's only available if you have
if you make the LLC.
Right. Exactly, that's it. But let's talk for a moment with your buy and hold investor. A buy and hold investor generally should not use an S corporation. There are some very limited scenarios where that would apply outside the scope of today's discussion, but generally, buy and hold investor does not want to use an S Corp. And the reason is the tax, again, why, for tax purposes, why would you use an LLC? Why would you use an S Corporation? Any takers? Payroll tax, right? That's what we've been saying. But rental income is not subject to payroll tax.
Correct.
So you have no tax reason to do it. And then here's where the downside is. And you'd be amazed at how many people have rental properties in S corporations because some attorney told them to do it. When you move assets between yourself and your business entity, there is a potential for tax liability. When a corporation distributes property to the corporation's owners, the corporation must recognize gain. It's as if the corporation sold it at a fair market value. So if you had a buy and hold property, you bought well and it appreciated, and now for whatever reason, a couple of years down the line, you got to get it out of the LLC. Out of the LLC, that's a corporation, or a C Corp or S Corp. You've got to get it out of the entity, maybe for some sort of financing reason. For some reason or another, you want to get it out of this S corporation. But you're not selling it to a third party. You're keeping it for yourself, but you have some sort of outside reason. You can get better, more attractive financing outside of the corporation, outside of the S Corp. Well, you bought the property for $100,000. Today it's worth $1 million. Guess what? If it's in an S Corp and you distribute it from the S Corp, you just recognize $900,000 of taxable gain.
And right.
But if it was an LLC that's disregarded, those distributions are not treated as sales. The entity would not have to recognize a gain based on the fair market value of that property. So having properties, buy and hold properties that have serious appreciation potential inside of an S Corp can have very, very serious unintended consequences.
Right.
So in general, buy and hold properties, you're using that LLC without any type of corporate election. Flipper, you would consider an S corporation. And that's like a whole subject into itself to figuring out when you should make that S election. Is it advantageous? When it's advantageous, what are all the unintended consequences of that S election? Because I do think it has its place, but I just encounter way too many people that have S corporations that are costing them money and not giving them any savings whatsoever. It's costing them money, and it's a major compliance nuisance to have an S corp. If you have an LLC, it's just so much easier to manage. So you have to reach some, and today after tax reform, there's so many moving parts. So ironically, having an S corporation can end up costing you money in taxes. And this is something that I experience all the time. So anybody out there shouldn't be thinking, get an S corp, it's going to save me tax money. It may not be the case.
Well, there are maybe instances, and we're not going to get into this now, but I'm sure there are instances where, and this is why you need to speak with an attorney or an accountant when even forming these things, because there are certain instances, like having a blocker entity, for example, would be a case where it may be advantageous to have that S corp. So there are certain nuances to it.
A lot of nuance. A blocker entity would be a C corp, but absolutely.
Sorry, you got me.
Yeah. So absolutely, yes. Blocker entities can be. Now, blocker entities come into play in retirement accounts.
Of course.
They come into play with foreign investors. They come into play with people that are various reasons don't want to show income on their personal tax returns. So blocker entities have their place, but for most investors, a blocker entity is not going to be applicable. But absolutely.
Very nice.
So there's Bobby, Yonah. We can talk about this for hours and hours.
Yeah.
Let's see if we can kind of what's the word I'm looking for? Just kind of
bring it back to a happy kind of a place.
Yeah.
What are the actionable steps? Recap. Yes. Couple of bullet points.
That's the word I was looking for. Let's get the recap and let's see if we can bring it home.
Right.
All right. Business entities. You want them 2 reasons: legal, tax, primarily legal. Asset protection. Within that realm, find yourself somebody that knows what they're doing, a reasonable provider, and it becomes a no-brainer. Don't overthink this. And something we did not mention earlier, and I'm going to provide this in the recap. If you form a Nevada LLC and you've got a property in California, you do not have asset protection unless you register that Nevada LLC with the state of California. And so in that case, you will inevitably be paying 2 states for having an LLC. So if you are doing business in Texas and have a Texas LLC, you will only pay Texas LLC fees, which are really limited in most cases. You're not going to get a Texas LLC fee. You'll have to do an annual filing with them. But if suppose you have an asset in Texas and you've got a Nevada LLC, that Nevada LLC better be registered in Texas if you want asset protection. Taxes. In most cases, there is limited tax benefit to having an LLC, but it provides the ability to make tax elections that otherwise would not be available. So if you want to have the ability to make an S election, you want to have that LLC. You may not be ready to have that. You may not even be certain. You may be on the fence about making that S election, but you need that LLC in place if you want to be able to make it. So on the legal side, asset protection. The tax side, the ability to make advantageous tax elections. So that's broadly speaking why you would have an LLC or an S corp. Now let's talk about investor profiles. Quick recap: buy and hold investor, LLC, no S election. Flipper, wholesaler, somebody that's going to be generating ordinary income, you would want to consider an S corp that has the potential, and I can't say that enough, the potential for tax savings. That's really it in a nutshell.
Yeah,
quick enough.
That was great.
A quick question, Bernard. A lot of people are flippers and buy and hold, so they should create two different entities. One.
You got it.
Okay, got it.
Absolutely.
Got it.
And really, once you start bringing in partners, people working together, which is something you mentioned when we kicked things off, then you may want to start thinking about kind of stacking your entities, having tiers of entities. Because again, remember, if you have two people in an LLC, it becomes a partnership.
Yep.
Now think about this. If you're doing business you've got one person, your business partner, and you guys doing lots of deals together. And now you want to form multiple LLCs. Because remember, if you have all your assets in a single LLC, how much asset protection do you have?
No. I mean,
I
all your assets are in
mean, you have inside.
You've got maybe some outside protection, but you've got really no inside protection because everything is inside.
Everything's going to be knocked off the other. Right?
Exactly. So if you've got, you want to figure out which point, you want to segregate your liabilities. That's really the name of the game. Segregation of liabilities. Well, so say you've got a partner and you're a partner in a couple of assets. We've got a couple LLCs. Well, every LLC will be its own partnership, its own 1065. That's a real nuisance. Your accountant will love that because he's going to ding you for every single one of those filings. So accountants, just so you know, accountants like partnerships and S corps. They love them. To streamline your reporting, you may want to consider having one partnership LLC that owns all the other LLCs. And this way you only have one partnership and all the other LLCs are disregarded entities. So you get one 1065 filing, not 10. Is that making sense?
Yes.
Yeah. So is there a name for that kind of thing, or is that just
there's no real name, parent-child setup.
Right.
It's just trying to illustrate the concept. But the idea is it's having tiered, layers of entities in order to streamline your tax reporting.
Got it.
Very nice.
Makes sense.
Nice. Very helpful. Anything else, Bernard, on that? To kind of like Yonah said, to recap it. I think you covered everything, right? That we wanted to cover in this podcast. But
yeah, I'd say maybe what's the one question that a person who's looking to, even before they're looking what kind of entity they should make, right? When they're looking to buy a property, what's the first question they should be asking themselves? There's probably like 10 questions, right?
Yeah, this sounds like something that belongs in Family Feud.
It actually was, but
so that's an inside joke.
Sorry, Bernard was the guest on our Family Feud we did at a.
Oh yeah.
And he actually was the winner of the Family Feud. So that's.
I got you.
So really, the fundamental questions should not be about anything we've discussed. The fundamental questions should be about the merits of the deal.
Right.
So all that we've discussed is important, but it's irrelevant if you don't have a deal. So the first question is, what's the deal? Now, people might ask, when should I form the LLC? Right? Do I wait till I have the deal? At which point do I do it? There's no one correct answer to that. But my general thought is if you've picked your market, form the LLC. Because when you find the deal, time becomes essential. And if you're going to want to use an entity, you don't want to start thinking then how to form it. Well, some states are great. They can form it instantaneously. Other states, you're in California, so I'll just use that example. California's not so predictable. How long it takes to get an LLC formed, not predictable at all.
Yeah.
You've got a neighboring state. Lots of California people do Arizona. Arizona is awful. Forget about it. Even if you pay for expediting, it may take you 3 months to get your LLC.
Yeah.
New York is quick. But there are a lot of players here. When you get the deal doc set up, they need to know who the purchaser is going to be. So you want it, if you've picked your market, you more or less, I'd say, form the LLC. Because I think overall it's a small cost. And all it can do is it will solidify your commitment. Yes, if getting an LLC set up is going to cost you a couple $1,000s, then you should hold off.
Right.
But you shouldn't be doing it an LLC that costs a couple $1,000s.
Right.
It's costing you that. Something is wrong.
Right.
Something is not right. Yeah. And the other thing is you want to try to, in anything financial, the problem is bias. Bias. And bias comes from two places. It comes from people that have a business model that's somehow tilted towards one thing or another, or people that don't have knowledge about all the possibilities. And there's a world of possibilities out there, and you have to choose that. So if anybody is promoting Nevada, Wyoming, New Mexico, Alaska, Delaware, any other offenders out there that I haven't enumerated, that is not to say that these states are not right for you. But anybody that is excessively promoting that has an agenda, and there is a conflict of interest there. Yeah. And it may be the best thing for you to have a Nevada LLC, but you're not getting information from an honest, unbiased source. But again, if your local accountant is only comfortable forming an LLC, his knee-jerk reaction is California or New York, that's not either unbiased info, right? You kind of need to be working with somebody that has a global perspective.
A more holistic, global, unbiased objective.
Absolutely, where they're kind of indifferent. To them, it's all the same. Yep. They're just as comfortable getting the LLC set up in Nevada as they are in your home state. Yep. So they have no incentive to push one way or the other. Yep. And on that note, there are lots of companies out there that will form LLCs for you for a fee. Yep. Now, I have found those companies to be less than, here's the issue with those companies. Essentially, it's actually harder to work with them than to work with the state directly. Because those companies, they just ask you a series of questions, and then they have a clerk somewhere that punches exactly what you put in, into whichever state. Now, they're going to be more familiar with working with the state than you are, but there's no real value being provided, and you cannot rely on them to get any meaningful information. And there's some nuance sometimes. Not every LLC should be formed exactly like the other. So it's interestingly enough, for the price they charge, very often you can, for that same price, a little less or a little more, you can get real insight into what's best for your scenario. So overall, I think you got to come back to what we opened with. You're at the center. You have to realize that you got to ask the questions.
Yeah. It's your finances. You got to take the action. Yeah. And this is what I tell people all the time as well, for taxes. People are just relying on their accountant to do whatever they want to, they're not being proactive themselves enough to educate themselves about their own finances.
Right.
Yes, it's I wouldn't totally fault the accountants. Wait, no, it's
no. I know, Bernard. It's all right. You're with friends.
Here's the thing. People generally are in, firstly, IRS compliance is a world in itself. So tax strategy and filings are two different worlds, and generally they'll appeal almost to two different minds. The kind of person that likes doing strategy will detest doing tax filings. And the type of person that loves doing tax filings doesn't want to touch strategy.
Right.
But people tend to conflate the two. They think accountant, tax, filing, it's one big world. And it really is not. And now even those, and mastering filing and compliance work, it's kind of a world into itself. It's very procedural. But if you get a tax return that has 300 pages in it, right, you imagine there are a lot of forms there.
Yep.
And you've got to know, you shouldn't be just relying on the software and punching those in and praying that the software is right, because the software makes mistakes too. Right? You've got to know how those are supposed to be completed. And then, so that's one thing. Consumers have to appreciate that there are two distinct components to this. And secondly, consumers very often, they're only going to pay the accountant to do the tax return. You've got to realize tax strategy side is a world unto itself. And if you want it, your app CPA may be able to offer it, but you may have to bring it, show him that you're the type of client that wants it and is potentially willing to compensate him for that. Otherwise, it just becomes a filing mill. They get compensated for doing filings.
Exactly.
Perfect.
I think you hit on some amazing points, Bernard. You are always an extremely overflowing wealth of knowledge. Yeah. And, we're just fortunate enough to have you to tap into a little bit today. I know we covered some huge topics today and try to condense it down to just get, glean some points that we can take home. So I appreciate you sharing that with us. Yeah. And Bobby, why don't you?
Yeah, thank you, Bernard, and thanks, Yonah, for introducing our audience to Bernard. Bernard, I want to echo what Yonah just said. Really grateful for all your insights. Just tremendous amount of information. Would love to maybe have you, if our listeners, our viewers want to find you, can you tell us about where we can find you? And I'll be reaching out to you soon as well. So if you don't mind sharing your website or your contact information.
Certainly. Best place is, to keep it simple, you can just Google Reisz Financial. The actual website URLs are 401kcheckbook.com and agentfinancial.com. That's 401kcheckbook.com as well as agentfinancial.com. But just Google Bernard Reisz. You'll find lots of stuff out there. Or Reisz Financial. You should find lots of good stuff.
Awesome. And Yonah, what a great way to kick off our podcast. This was really wonderful, totally engaging. Yonah, just if people want to find you, you are the cost segregation expert. I think everybody knows that, but if people are still looking and they want to reduce their income, tell them a little bit about yourself.
Yeah, if you don't know me yet, just go to LinkedIn.
Yeah,
that's all you need to do.
If you don't know Yonah yet, you must have been under a rock.
Yes. Yep. Yeah. All right. So thank you both, and Bernard and Yonah, the invitation is always open. If you're in the Bay Area and you want to come and speak to our members, you're always welcome.
Absolutely. Thanks,
Bobby. Great to be your guest on this show. Wonderful to meet you in the Bay Area in person. Yeah. Yonah, thank you so much for having me. And again, this is a real honor to be on the kickoff episode hosted by Yonah and Bobby, two people that I hold in high regard, and two people that are social media geniuses, huge audiences, and deserving of huge following. So to be on this first episode is a true honor. Thank you for having me.
Thank you, sir. Have a great day.